Hi, good afternoon, everyone. This is Elki here with you guys today from Bajaj Securities. Together with Bajaj Research today, we're gonna have our fourth quarter 2025 economic and market updates. Okay, so with me together here, I have my our team of research analysts to share with you guys their view and insights on how to better position for the last quarter of 2025. All right. So first, I will invite Victor to share with us to start with us with today's sharing sections. Victor, the floor is yours.
All right, thank you, Elki. Good evening, ladies and gentlemen. Thank you for joining us for our fourth quarter 2025 economic and market updates. Um, Next slide, please. Right. So, as you can see from the title, it's actually holding steady as optimism builds. Basically, things are looking a bit more settled at this point, but we'll explain more in a few moments together with my team. Next slide, please. And This will be our agenda for today. I will start off the economic side of things with the global and Malaysian economic review, and I will follow that up with the economic outlook and what we expect to happen in the final quarter of the year. Later on, our head of research, Kenneth, will provide you with the equity market review as well as the market outlook, as well as the technical side of things, which will also be presented, and the remaining and our remaining team members will provide you with the stock picks for the upcoming quarter. Next, please. Right. So on the global economic review, if you look at the table, you can see that things are actually looking quite stable in the second quarter of 2025, despite all the tariff uncertainties. So, what has happened was this came about after President Trump announced a pause on the tariffs for 90 days. So, as a result of it, this helped to normalize global trades as well as increasing the bouts of front loading activities. So, collectively, all this actually helped to contribute to the growth during the second quarter of the year. Nevertheless, if you look at it, the performances were also quite mixed. There were increased volatility as due to the lingering uncertainties over the tariff, and of course the corresponding cautiousness over the slower economic activities. So apart from the tariff concerns, there were also worries over the geopolitical environment, and that also caused a lot of countries to the cautiousness basically uh, saw countries slowing down their domestic economic activities. So this was the main theme during the quarter. So looking at the chart, you can table, you can see that the U.S. actually outperformed in many ways. China held steady, whereas Japan also held steady, but any other most other countries were actually quite um, subdued as due to the tariff uncertainties. Next slide, please. Right. So, looking at what the main measures of both the demand and supply, we look at the global PMIs uh, up to the middle of this year. So you can see that all the key PMIs actually remain quite positive during the quarter, largely on the back of the front loading activities lah. So there was, if you look at the blue line, uh, there was a tip down in terms of demand for services. However, demand for manufactured goods actually rose, mainly because of the front loading activities lah. So as I said, individually, if you look at the US, the growth actually exceeded expectations, largely on firmer consumer spending growth, and also because of its strong employment prospects. However, their imports actually slipped somewhat due to the 10% tariffs. The tariff, however, the tariff impact was also quite more subdued after the postponement of the tariffs for 90 days. As I said earlier, Europe's growth was actually quite steady, uh, but there was a fragile recovery due to the trade policy uncertainties and, of course, subdued investments as a result. Elsewhere in most Asian economies, cautiousness prevailed, and as a result of it, growth was largely still tepid. Moving on to the Malaysian side, I can see that the economy actually posted quite a decent performance at 4.4% in the second quarter of the year. That means it's also up by 2.1% quarter on quarter. So, taken as a whole, in the first half of the year, GDP rate was at 4.4% as well. Overall, like I said, performances were quite resilient, mainly anchored by stable domestic activities, and of course, that was helped by the healthy labor market, and of course, helped also by government-led policies. But nevertheless, the impact of the 19% tariff, the US tariff on Malaysian imports into the US, has actually yet to filter through to the economy and is likely to be only felt in the last quarter of this year. If you look at it in the trade wise, in the second quarter of the year, external trade was already um quite weak, with net exports actually contracting by some 73%. You compare that with a growth of about almost 20% year on year in the first quarter of this year, mainly on the back of the front loading activities lah. So if you look at the table, you can see that domestic demand actually was the main contributing factor for the sustained growth uh, in the Malaysian economy, which domestic demand actually improved by some 7%. Also helped by a lot of fixed capital investments, where it rose about 12.1%. So all this actually were quite instrumental in preserving the country's economic growth in the second quarter of this year. Next slide, please. No. So, if you look at just on the export side, the gross exports growth actually slowed by 3.4% compared to 4.3% growth in the previous quarter. So a lot of this was sustained by the electrical and electronic exports, but that offset the weaker mining and non-E&E exports. As I said earlier, domestic demand was actually driven by very much on the firm side, driven by stronger private consumption, which grew at 5.3% in the second quarter. So you compare that to the first quarter, it only grew by about 5%. A lot of it, again, as I said, higher household spending that was supported by the positive labor market conditions. Uh, in terms of gross fixed capital formation, it improved by 12.1%. Strong investments were seen in the machinery and the equipment segment. At the same time, also strong investments into structure, such as those in data centers. So that saw overall investments into structures improving by about 10.5% on a year-on-year basis in the second quarter of the year. Looking at the specific sectors, the services sector also uh, performed credibly with a growth of about 5.1% in the second quarter of this year. So it was slightly higher than the 5% that was reported in the first quarter. And a lot of it was supported by wholesale and retail trade, the retail trade subsector, which posted a stable growth of about 4.3%. While other services centric contributions were also quite stable and were also on a resilient note. In other sectors, the agriculture sector posted its second uh, sorry, the agriculture sector posted a growth of about 2.1%, which was actually quicker than the less than 1% growth in the first quarter of this year. And mainly, much of it was contributed by the palm oil subsector lah. Nevertheless, mining and the quarrying activities remain downbeat. It actually contracted for the fourth consecutive quarter at minus 5.2% year on year lah. So it's also almost double, more than double that of the first quarter performance, which rung in a negative 2.7% year on year contraction. All this is basically due to weaker output and the sluggish external demand. On the manufacturing sector, the its growth actually moderated to 3.7% in the second quarter compared to 4.1% in the first quarter. Um, Essentially, non-E&E manufacturing output actually slowed. But if you look at the performance of E&E products, it actually improved by some 7.3% year on year. Which was little change from the first quarter of 2025 lah. Looking at the construction sector, it posted a growth of about 12.1%. A lot of ongoing construction, essentially on data centers. So the work completed during the quarter was at nearly 44 billion, which is higher than the first quarter's total of about 43 billion. So in terms of looking at the manufacturing statistics, you can see that exports, which is the black line, is actually quite checkered, and it is also very much dependent. Most of the growth actually came out in the first quarter of this year, during the time when a lot of front loading activities are. So corresponding with the slower exports, you can also see that the manufacturing production was also quite unsettled during the quarter lah. But nevertheless, the labor market conditions remain solid. Unemployment rate was at 3%, which is a slight decline from the 3.1% reported in the first quarter lah. Labor market participation also increased to a record high of nearly 17 million people, whereas private sector wages actually recorded a gain of about 3.4% year on year in the second quarter of this year. So that's a quick review of the global and Malaysian economic conditions. We now move on to the global economic outlook. So, all in all, you can see that global economies have stayed relatively resilient in the first half of this year, and even up to now, they're still showing quite a bit of resilience. So that has actually helped um the global estimates, economic growth estimates, to be raised lah. So this is all despite the ongoing tariff concerns, and of course the ongoing geopolitical headwinds. So as a result of it, the GDP numbers have been lifted slightly lah, to reflect the limited impact of the policy, the tariff effects thus far lah. But having said that, you can see that the undertone is still very much subdued. Global growth, if you look at the table, from about from um, from about 2.8% now, it's just raised slightly to 2.9%. Just a minor reflection of the on the more settled uh, economic and trade conditions in the first half of this year. Similarly, you can look at it for all um the other countries and economic blocks in the table. You can see that the improvements are minimal, just to reflect slightly better conditions year to date lah. So far, the tariff impact has been relatively benign, and it's just starting to trickle into the global economy. Therefore, the effects have largely been muted for now, and then this is particularly true in terms of inflation. And of course, employment prospects have also remained relatively firm throughout uh, the year to date now. At the same time, also you can see that the both the ECB and the US and also many central banks that they have actually reduced reduced interest rates, and that has actually helped some of the ongoing trade concerns. So, as I said earlier, the global forecast has been lifted to about 2.9% for 2025. Previous estimates were hovering around 2.3 to 2.6%. So, this is actually just to reflect the stronger front loading activities and the more muted effects of the tariffs so far. Um, in terms of trades, I think the earlier on there was the World Trade Organization was estimating a contraction of nearly 1% in terms of global trade. But now with the front loading activities, they are now looking at a potential growth of about 0.9% uh, year on year in terms of growth, in terms of trade growth for the whole year. Lah. So from a negative position, now they're looking at a slight positive performance in terms of global trade in 2025. Lah. But nevertheless, if we look at it on the whole, there is cautious optimism, uh, at least in the third quarter of this year, mainly because the growth prospects have not been tempered significantly by the ongoing tariff concerns. And of course, many economies have also been able to absorb the effects of the volatility. Lah. What is crucial is that employment um, has remained relatively steady, not only just in the US but globally as well. And with the employment numbers holding steady, it has actually provided a lot of support to the much needed support to consumption. So, and also consumption on its own is also supported partly by the more uh, by the looser monetary policies. And here we're just we're putting in interest rates as the most crucial part in ensuring sustained consumer spending. At the same time, also there's also availability of ample financing. So collectively, all this is helping to shore up spending. And globally, the consumer spending growth is estimated at anywhere from 1.4 to 2.2% year on year for 2025, notwithstanding the fact that it could be lower than 2024's 2.3% year on year spending growth. It is at 2% or slightly below that. It is still considered a very decent growth for the for consumer spending globally. Right. Uh, yes, although consumer spending is expected to stay firm, investments could taper mainly because of the uncertainties over the trade barriers and, of course, the corresponding weaker economic outlook. So all this is going to weigh on mostly on investments in non-technology sector. There is still a strong spending in the tech sector because of the increasing prevalence of AI and, of course, the upcycle in the semiconductor segment now. So the other concern right now would certainly be um, in interest rates uh, because because inflation may spike up later on, especially from the fourth quarter onwards, when the existing inventories are replenished at higher cost, and this could actually negate some of the earlier effects of the lower interest rates. But nevertheless, I think right now the consensus estimate is for global inflation to remain above the threshold of many central banks of 2%. So the forecast right now is now at 3.6%, even though it's cut slightly from 3.8% earlier this year, mainly because the effects of the tariffs have been relatively benign year to date. So, despite the US yearly GDP forecast uh, has been lifted to about 2.1%, like I said, fourth quarter may prove to be a more challenging um, period for the US economy when the tariff impact is likely to filter into its economy. So, with the higher prices, its consumption could slow as prices of their imported goods are actually going to reflect the tariffs. So when all this comes in, there could be a slowdown in consumption, and at the same time, also inflation may pick up slightly to about 3.1% in the final quarter of the year. In other parts of the world, Europe's forecast has also been lifted, but even so, the growth rate is likely to be relatively subdued due to its weakness, its on domestic weakness, as well as the policy uncertainties. In Asian economies are also likely to see very tepid growth rates for the rest of the year, mainly because of the challenges to their respective external environment, right? So all in all, the global economic outlook for the final quarter of the year is likely to just stay, stable, I would say, but there could be alarm bells ringing into the final parts of the year when the effects of the tariffs are imputed into the economy itself. Right, moving on to the Malaysian economic outlook. So these are the latest forecasts, consensus estimates on the table, which is not much change from the previous estimates. So as it is, it remains the outlook for the Malaysian economy remains clouded by the U.S. tariffs on Malaysian exports. But not only that, what is more critical is the effects on the challenging external environment on the country's exports in general. So all this is likely to cause uh, a slowdown in exports for the remainder of the year. But nevertheless, if you look at it, overall growth in terms of in GDP terms is likely to remain quite sanguine at anywhere from 4 to 4.8%. This is the official Bank Negara forecast. But if you look at the consensus estimate, it is anywhere from 3.9 to 4.2% year on year, which is little change from the previous forecast. And of course, this is mainly due to the increased trade barriers that is causing a cascading effect to the country's exports and its manufacturing sector. So even though that with the exports likely to remain on a slow gear, it is up to domestic spending and activities to continue providing the impetus for the country's growth for the rest of the year. Um, Looking at it, we think that there will be some 0.5% impact on the country's economy, mainly emanating from the 19% tariff on Malaysian exports, uh, as well as lower exports, re-exports to other key exporting countries as well. The only salvaging point at this stage will be that there should be still strong demand for E&E products due to the increasing use of AI, and of course, as I said earlier, the technology upcycle. But non-E&E and minerals exports could be weaker due to the lower demand. On the salvaging part is definitely the tax or tariff exemption on semiconductor exports to the US. So that would actually help to shore up the demand for the country's E&E output as well. Meanwhile, the Another mitigating factor would certainly be the country's diverse export base that would help to mitigate some of the volatility in exports. So, in all, the estimate is for Malaysia's export to grow at a very decent rate of 4 to 5% in 2025. So, if you compare that, it's still slower than 2024's nearly 6% growth. But even so, I think 4 to 5% growth is very decent given the under the prevailing challenges. In terms of Malaysians' domestic activities, it is seen as vital to cushion against the weaker external environment. There's still a lot of ongoing and upcoming domestic activities, as well as continuing consumer spending that could provide the impetus for the Malaysian economy to post the decent growth of about 4 to 4.8% for the year lah. Spending wise, earlier we had the civil servants pay rise, higher minimum wage, and the lower RON 95 petrol rates. All this is going to help to create the cascading effect to consumer spending, and that will also help to shore up consumer spending in the country as a whole lah. So apart from that, also we have the various ongoing infrastructure developments that will provide the much needed boost not only to the construction sector but uh, due to their wide ranging effects to other sectors such as building materials, manufacturing, as well as transportation and services sectors lah. Right. So all this actually points to one important criteria to sustain Malaysia's economic outlook, and that is employment. So employment is likely to stay firm in for the rest of the year. The employment rate is expected to hover around the 3% level for the foreseeable future. So this is actually going to help to sustain the private consumption, which is likely to grow by about nearly 6% in 2025, which is again higher than what was recorded in 2024 lah. At the same time, also the investments are also tipped to increase by about 9.3% for the year. And a lot of these investments will be channeled to the technology sector uh, due to the advent of artificial intelligence. And of course, significant investments are still ongoing into data centers as well as transportation and energy and utility infrastructure lah. So all in, if you look at it, these the on the table on the next on the right, you can see that except for mining, all sectors are likely to continue posting growth, with GDP expected to hover anywhere from 4 to 4.8%, according to the sources, the Banagara source. On the upcoming budget, as you can see, the government has already provided uh, a lot of subsidy reduction and targeted subsidies that has been announced off budget. So these have not been announced. So I do not see a lot of new goodies or any more significant um, new plans that will be launched in the upcoming budget this Friday. So it's more of fine tuning and reinforcing what was already announced by the government earlier throughout the year. And it was just trying to see how they can manage the economy in view of this challenges. So I do not expect the upcoming budget to have any significant impact on the Malaysian economy or new measures that will be that could translate into significantly new developments in the Malaysian economy. So with that, I've come to the end of the Malaysian and global economic updates. I now pass you on to Kenneth, who will proceed on with the with the global and Malaysian equity markets. Over to you.
Okay, good evening, everyone. I shall continue with the global market review. After delivering a solid first half 2025 performance, global equity markets marked another positive quarter as market participants welcome converging tailwinds stem from clarity of trade policies following the finalization of reciprocal tariff rates, resiliency in corporate earnings growth, and stability in economic data. Also, much of the gains were spurred by the rising expectations of US Federal Reserve interest rate cuts, a policy shift billed as supportive for equity valuations and risk appetite, which eventually took place in September 2025. Wall Street charted new heights in the third quarter of this year as market responded favorably to the finalization of trade agreements between US and its major trading partners, as the softer policy stance help mitigate concerns over potential downside risks to global growth from the escalating trade conflict. All three major indices, the Dow, S&P 500, and Nasdaq, rallied, with the tech-heavy Nasdaq led the gains. This was underpinned by the strength in the Magnificent Seven, whereby six constituents, excluding Tesla, reported stronger quarterly earnings. European equities performance were brought about by easing US-Europe trade tensions. The European Central Bank (ECB) kept interest rate unchanged in July 2025, effectively marking the end of its current easing cycle after eight cuts over the past year that brought borrowing costs to their lowest level since November 2022. The DAX slipped 0.1% Q on Q on softer economic data, while the France's CAC 40 gained about 3% Q on Q despite political uncertainty. The FTSE 100 outperformed, rising by 6.7% Q on Q, supported by stronger GDP growth and favorable US trade deal. Coming closer to home, Asian equities steered higher in third quarter 2025, supported by attractive valuations as well as clarity over US trade policies. Chinese markets led gains with the Shanghai Composite rising by about 12% Q on Q. This followed by the Hong Kong markets, whereby the Hang Seng market rose by about 11.6% on Q on Q. At the same time, the Japanese markets also outperformed, rising by about 11% Q on Q, driven by the easing tariff, solid corporate earnings, and also the improved in governance. Back home wise on the Malaysia markets, the FMKLCI ended last quarter on a better footing at about slightly above the 1600 psychological level, effectively marking about 5.1% Q on Q gains. The positive stance was an extension from the rebound that took place since mid-April 2025. The local boss cheered onto the more favorable trade deal with the US, tabling of a 13 Malaysia plan, stable economic growth with second quarter 2025 GDP at 4.4% year on year, as the firmer ringgit against the US dollar also helped to push the markets higher. Meanwhile, the lower liners also advanced in tandem with the positive performance on the FMKLCI, with the small cap and ACE registered 3% and 10.3% Q on Q gains respectively. Sector-wise, the technology sector emerged as the biggest winner, rising by 12.8% Q on Q. Trading interest within the sector returned on the back of the attractive valuations, improved semiconductor demand, particularly for servers, AI-related hardware, and cloud, as well as easing concern over the tariff risk. In contrast, the healthcare sector tanked by 7.9% Q on Q after falling as much as 7.2% Q on Q in the previous quarter. This was brought down by weakness across the glove players amid the subdued outlook due to uneven demand recovery, as global oversupply condition will extend into 2026. In the third quarter, foreign investors remain net sellers of Malaysia equities, with net outflows totaling more than 4 billion. This brings 9 months 2025 cumulative net outflow to 16.2 billion. The outflow was largely absorbed by domestic institutional investors with net buying position totaling 4.35 billion during the quarter. Meanwhile, retail investors remain net sellers with outflow amounting to 153.1 million, extending their net outflows of more than 500 million in the second quarter. With sentiment tilted slightly favorable, particularly post-tariff clarity, trading activities recorded mild improvement with average daily traded volume stood at close to 3 billion, rising by 1.2% Q on Q. Meanwhile, average daily traded value climbed 13.2% Q on Q to 2.59 billion, as trading interests were largely skewed towards the larger cap stocks in evidence of the outperformance of the FMKLCI against the lower liners. For the outlook-wise, following the upbeat performance in the third quarter, further upside in the final quarter of this year could be more measured, with risk of volatility resurfacing as tariff impacts filter through the supply chain, margins, and rising consumer prices. Valuations appears less appealing at this point of time, particularly across US markets versus forward averages, raising concerns about sustainability should future earnings growth fail to keep pace, and potentially favoring rotation into defensive or value sectors. While the macro backdrop remains broadly supportive, anchored by the resilient US equities, steady economic indicators, and expectations of additional Fed rate cuts, near-term market upside is likely to be capped. US inflation data will be critical in shaping the Fed's policy path. For now, the market's consensus are pointing for another two rate cuts moving into the remainder of this year. The MSCI All Index trades at a forward PE multiple of 21.1 times for 2025 and 18.8 times for 2026, which is already close to the 5-year historical average of 20.4 times, suggesting that global equities are not excessively stretched on aggregate, but fair in terms of their forward average. For the US equities stand out as a clear outlier, with the S&P 500 trading at price to earnings ratio of 26.8 times, well above its forward average of close to 25 times and 22 times for 2025 and 2026 respectively. The valuation premium underscores the strong investor preference for US growth and technology leaders, but also raises concerns over the sustainability at these elevated levels. The durability of this premium will hinge onto the trajectory of US inflation and the Federal Reserve policy path, as well as ability of corporates to deliver earnings growth prospects. Elsewhere, the MSCI Europe Index is trading at price to earnings ratio of 15.3 times, broadly in line with its forward evaluations for 2025 and 2026. This reflects rising investor confidence in an improving macro backdrop, underpinned by prospects of monetary policy easing, stabilizing growth dynamics, and resilient corporate earnings. Looking ahead, Europe could stand to benefit from a recovery in industrial activity and relief from easing energy cost pressures. In contrast, the MSCI Asia ex-Japan Index is valued at 13.3 times, which is below its historical average of 16.5 and 14.2 times for 2025 and 2026 respectively. From a relative value perspective, the region could become increasingly attractive, particularly if earnings downgrade stabilize and monetary policy settings turns more accommodative. Over time, this backdrop may allow the valuation gap with US equities to narrow, presenting selective opportunities for medium-term portfolio rebalancing. Global corporate earnings growth has been revised higher slightly to 4.1% year-on-year for this year, from earlier projection of 2.1% and 12.9% for 2026. The upward revision in corporate earnings were mainly driven by sustained consumer spending, easing inflation, and standout performance in technology, and as well as consumer staples sectors. Moving forward, AI-related plays a dominant theme to drive substantial productivity gains and earnings, particularly in the technology and related sectors. Over at the US, the S&P 500 earnings growth projections are at 5.6% and 15% for 2025 and 2026 respectively, while 2025 earnings growth is expected to be skewed towards mega cap technology and AI-related players, 2026 is poised to deliver a more broad-based and sustainable recovery supported by revenue expansion across the stable economic growth, margin improvement and from tax cuts, and further monetary easing. Earnings in the MSCI Europe Index are set to climb close to 10% year-on-year and close to 12% year-on-year for 2025 and 2026 respectively, on the account of tariff normalization, stronger defense spending across Europe. Earlier this year, Germany's Chancellor Friedrich Merz announced plans to spend nearly euro 650 billion over the next 5 years, doubling its current military spending to hit NATO's spending target of 3.5% GDP target. Elsewhere, the MSCI Asia ex-Japan Index is seeing an increase in its earnings growth forecast of 2.5% for this year and 15.8% for next year. Earnings growth will be mainly emanated from growing middle-class consumption to sustain spending and foreign exchange tailwinds in anticipation of weaker US dollar, as well as the Federal Reserve takes on the more aggressive monetary easing in 2026. Back home-wise, going forward, investors will be keeping a close tab onto the tabling of Budget 2026 later this week. With the 13 Malaysia plan unveiled back in July, we anticipate the budget's policy stance to remain expansionary, anchored by 430 billion allocation for development expenditure over the next 5 years. This is compared to 410 billion that was spent under the 12 Malaysia plan. So market attention would direct towards the government's ability to manage their fiscal deficit amid elevated subsidy and debt servicing commitments. RON 95 subsidy rationalization is likely to dampen consumer spending as eligible is unlikely to dampen consumer spending as eligible Malaysians continue to enjoy petrol subsidized at RM1.99 per litre. The Sumbangan Asas Rama Asara aid has been expanded by an additional 2 billion to 15 billion, benefiting 22 million recipients. This also marks the largest cash assistance in Malaysia's history to help cushion the impact of subsidy reformulation and elevate tariff pressures. Following the 25 basis points cut in the OPR back in last quarter, Bank Negara is expected to keep benchmark rate unchanged for the rest of the year. Narrowing spread differential between the OPR and the Fed funds rate may lend support to the ringgit's strength prospects. This was evident in the recent periods whereby the OPR and FFR spread narrowed since third quarter 2024, coinciding with the gradual appreciation of the local currency. We favor several sectors such as the construction sector that is set to sustain strong growth from private projects across property, data centers, and semiconductors, alongside with continued public investment in infrastructure and housing that is supported by sustained development expenditure allocations. Higher development spending under the 13 Malaysia plan will further reinforce its role as a catalyst for Malaysia's long-term economic expansion. Meanwhile, the one-off SARA aid that must be utilized by 31st of December this year and the strong labour market with decade-low unemployment at about 3% are expected to support household spending to sustain private consumption growth, which bodes well for the consumer sector. Malaysia's renewable energy sector is set for sustained growth, led by solar expansion under the large-scale solar projects, rooftop adoption, and the corporate PPAs, with strong support from government targets, fiscal incentives, green financing, and ESG-driven investments. Malaysia is largely on track to meet the NETR target of 30% renewable energy mixed capacity by end of this year. Currently, the RE mix is at 29%, and the target is at 35% by end of 2030. Earnings growth for the FMKLCI and the AMAS projected to remain subdued at negative 2.5% and negative 2.6% for this year, owing to the impact of tariff uncertainties before marching at a stronger pace of 6.3% and 8.7% for this and for next year respectively. Valuation-wise, both the FMKLCI and the FM AMAS indices are attractively priced as they are trading below their historical forward average of 14 to 16 times. This provides bargain hunting opportunities, but further potential upsides will likely to hinge onto the macro developments and impact of tariffs. Throughout the past 5 years, the local bourse has been hovering between -2 and -1 standard deviation amid the absence of fresh domestic leads for potential re-rating. As the local bourse attempt to play catch-up with gains across regional peers, a measured recovery in the FMKLCI looks to be sustainable at this point of time as the key index looks to power through into the final stretch. Should the 1600 level psychological level remain supported, upsides could prevail with the key index looking to test the resistance of 1640 and 1675 levels respectively. That said, a failure to hold above the 1600 may likely to see a retracement towards the 1562 with the stronger support seen at 1540 level. So that's all from my end, and we shall move on to the stock picks for this quarter.
Hello, can you hear me? Okay. Hello everyone, Chong here, and I'll be giving some updates on SolarWest today, and that falls under the energy sector. So for SolarWest, the price has shown quite a bit of a run up, but overall we still remain very much positive on the renewable energy sector as a whole. And we believe that the RE players with commanding EPCC market shares, such as SolarWest, will be able to benefit and ride on the NETR policy tailwinds as we transition into net zero. Onto the company background, SolarWest is still the largest pure solar player, and in terms of the market cap, is standing at 2.5 billion. It is also the market leader for the solar EPCC segment, where we expect that on average it will be able to command about 30% of the total market share for the large-scale solar projects. It also has a considerable presence in the C&I and residential rooftop solar projects, and we estimate the contribution per year from the rooftop segments to come in around 200 million or higher. The three operating segments that it operates in are the large-scale solar, the residential, which is the home solar, and also the commercial and industry solar. SolarWest also targeted to increase its solar ownership to have around 30% of its revenue to come from the recurring source through solar ownership, which is through the sales of electricity. We expect that this will significantly improve its earnings visibility, considering the long-term tenures that gives certainties on the cash flow generation on top of the EPCC works. Currently, it has more than 300 megawatt peak of effective solar asset portfolio that is covering the LSS4 assets, CGPP, Brunei assets, which they won earlier this year, LSS5 and also LSS5 Plus, and PowerVest, where they have already signed for more than 129 megawatt peak of capacity. So overall, we expect SolarWest to benefit from tailwinds of the energy transition agenda set by the government under the NETR, whereby the government has targeted for the energy generation mix from renewable energy to reach 40% by 2035 and 70% by 2050. We expect this to create a constant flow of EPCC opportunities, at least for the next 30 years to come, for local solar players. Despite the very intense competition within the EPCC domain, we still see SolarWest to gain on the back of its dominating market share of more than 30%, which is likely to yield better scalability and procurement planning. On the solar ownership, SolarWest is still on track to get 30% of its total revenue from recurring income through electricity sales, where it has won a few assets ownership, which I will share later. The near-term order book will be replenished by the LSS5 and LSS5 Plus projects as the bidding rounds were already over. We expect similarly about 30% of market share gain for this program. With that, we recommend a buy on SolarWest with a TP of 3.42 ringgit, which implies an upside of about 17%. And this is based on our sum of the parts method, where the EPCC is pegged at 30 times and the solar ownership is based on a DCF valuation. The implied FY27 forward PE based on today's price is about 29 times. Onto its order book, as you can see that the EPCC order book has grown to about 1.2 billion as of June end, and most of them are actually comprising of LSS, and the rest are CNI and residential of 264 million. We expect this order book to provide earnings visibility for at least the next 12 to 18 months before the LSS 5 scheduled commercial operation dates of next year, somewhere around December. And onto the recent updates, SolarBest has secured a solar ownership with effective state of 60% in Sarawak. The total capacity for this project is 100 megawatt, and the electricity will be supplied to SESCO for 30 years after the SCOD in November 2027. So with that, our IR assumptions of 7 to 8% and investment cost of 3.8 million per megawatt. We expect the electricity sales to contribute to its bottom line starting FY28 onwards, and this will further cement the recurring income inflow and potentially paving ways for higher solar ownership penetration in Borneo states in the future. Meanwhile, for the financial highlights for latest quarter, which was the first quarter of FY26, the PATAMI has improved by more than double, which is around 102.5% on year-on-year basis. This is mainly due to the execution of CGPP projects when compared to last year. Also, at the same time, PATAMI lowered by, declined to 15.9 million in the latest quarter from previous quarter of 20.5 million. And that was due to a slower progress of CGPP as the project comes near completion, as the SCOD date is set to be by end of this year. So regardless, the net margin is still higher, and that's mainly because of a better profitability mix, as C&I segments typically commands better margin. So moving forward, SolarVest order book is expected to continue to grow, with management targeting an order book of 3 billion by end of this year. So we expect its bread and butter business, such as the C&I and residential projects, to generate at least 200 million ringgit of revenue per year, with higher margin compared to utility scale solar. Meanwhile, we also expect further inflow of utility scale opportunities for LSS 6 following the conclusion of LSS 5 and LSS 5 plus tenders. However, there's no details on the scale of capacity rollout yet for now, but it is expected that the tender should open by end of this year. We should also see more uptakes for CREST now, with the corporate off-taking becoming more viable following the reduction of the SEC charge. So for the firm outputs, the rate is now reduced to 20 cents per kilowatt hour from 25 cents per kilowatt hour, and that is also coupled with the declining of the battery cost as well. So SolarVest is also tendering for My Best program of about 100 megawatt, and the bidding results will come out by end of this year. So a couple of things that have changed that have changed recently. That would be the newly introduced ATAP, which is set to launch this December. So this program is meant to replace the previous NEM. A couple of notable changes will be the credit offsets will now be based on S&P rates against the energy charge portion, instead of a one-to-one offsets like previously. So although this will reduce the potential saving for general household, we expect the ATAP regime to be more sustainably in place in the long term, as there's no restrictions on quota unlike previously, and the restrictions on system sizes has also been relaxed, where the installed capacity can now be maxed up to its maximum demand. Overall, we still see that SolarVest will continue to ride on these opportunities, and its current intrinsic value is implying the stocks to be relatively undervalued. So with that, I'll end my presentation for today. I'll now pass it over to Chloe to continue with her presentation.
Good evening, everyone. I'm Chloe. Today I'll be presenting on OCK Group Berhad, a company that I believe stands to benefit from the upcoming Malaysia Budget 2026. With the government expected to continue to focus on digital infrastructure, nationwide connectivity and renewable energy, OCK is well positioned to ride on these policy tailwinds. So a quick introduction. OCK is a regional telecommunications infrastructure and services provider with presence in Malaysia, Myanmar, Vietnam, and Indonesia. While its core strength lies in its TNS business, the group has also strategically diversified into high-growth sectors such as green energy as well as power solutions. As of today, OCK manages a portfolio of over 5,500 telecommunications towers across Malaysia, Vietnam, and Myanmar, as well as owns 30 solar farms within Malaysia. The group maintains a solid order book of 260 million ringgit, comprising 170 million ringgit from its TNS segment, boosted by newly awarded mobile 5G sites for tower deployments, while the remaining 90 million ringgit from non-TNS projects, of which 70 million relates to data center power solutions. Meanwhile, the tender book remains robust at 1.6 billion ringgit. As we head into Budget 2026, the focus areas are expected to include digital infrastructure expansion, nationwide 5G connectivity, and green energy transition. Momentum in OCK's TNS segment is projected to accelerate in FY26 in tandem with the deployment of Malaysia's second 5G network and the launch of Jendela Phase 2 tenders, expected in the fourth quarter of 2025. With an estimated budget of 4 billion ringgit, Phase 2 is expected to surpass Phase 1 in scale, presenting a substantial growth opportunity for the group. Adding to this, the MCMC has announced expanded efforts in Sabah and Sarawak, introducing additional connectivity solutions for remote and hard-to-reach areas under the Jendela Phase 2. Furthermore, New Mobile has appointed OCK as its preferred next-generation 5G in-building coverage infrastructure partner. So far, OCK has been awarded projects for 20 buildings, and successful execution of these is expected to pave the way for a larger share of New Mobile's 400 targeted buildings over the next few years. Regionally, OCK's operations remain on a solid footing. In Indonesia, the group now manages services for around 50,000 towers, strengthening its recurring income base. And in Vietnam, it continues to expand its tower portfolio through targeted acquisitions. Beyond TNS, OCK is expanding into digital solutions and data center projects to capitalize on the global trends towards digitalization. Its 52% owned subsidiary, EI Power Technologies, plays an important role in providing backup power systems and fiber connectivity solutions for mission-critical facilities such as data centers. To unlock value and raise capital for future expansion, OCK has proposed to list EIPT on the ACE market of Bursa Malaysia. The listing will enable OCK to accelerate its push into the fast-growing digital infrastructure and data center segment. Lastly, OCK continues to strengthen its presence in government-related projects through the participation in the Phase 2 broadband connectivity upgrade program for the higher education institutions and is looking to contribute to Phase 3 expected to be rolled out later this year. So taking all these growth factors into account, we reiterate our buy recommendation on OCK with the target price of 65 cents based on an unchanged target EV/EBITDA multiple of 7 times pegged to our FY26 EBITDA. Based on today's closing price of 49 cents, there is a potential upside of about 32.7%. Now, looking from a technical perspective, OCK is showing early signs of a trend reversal. We are seeing a clear shift from a sideways consolidation to an emerging uptrend. Previously, OCK had been trading within a tight range between 40 cents and 45 cents, and recently it broke above this resistance range, confirming a technical breakout and signaling improving momentum. Right now, the price is testing the minor resistance cluster around 50 cents. We may see some profit taking at this level after the recent strong move, but the overall upside bias should remain intact as long as the price holds above the 45 cent support zone. If you get a healthy pullback followed by a re-break above 50 cent, that could lead the share price to trade higher towards 57.5 cent and possibly a retest of the 2024 high near 69 cent. That wraps up my first topic, and I will move on briefly to my second topic, which is Able Global. Able Global is principally involved in two core business segments, which is F&B and tin can manufacturing. Starting from 4Q last year, the group also began recording maiden revenue from its property development segment from the progressive infrastructure works on its Kappa land development. So as for its overseas operations, the Mexico joint venture continues to deliver encouraging results. It has contributed positively to the group's earnings for 2 consecutive quarters in CY25, and we expect this contribution to strengthen further as production utilization rate improves. As of 2Q CY25, the utilization rate in Mexico has reached 43%, up from 40% in 1Q CY25 and 36% in CY24. Based on the current trend of growing domestic and export sales, we project utilization rate to reach about 50% by year end. Sales to the US account for approximately 10% of Mexico's output, and these exports enjoy zero import duties under the United States-Mexico-Canada Agreement. Beyond the US, the group has also been expanding its export footprint across the Americas and the Caribbean region, helping to reduce market concentration risk while tapping into new regional growth opportunities. On the corporate side, Able Global recently announced that its executive chairman has been discharged and acquitted from all charges related to alleged abetment of dishonest misappropriation in his private business. This follows the earlier conclusion of investigations into its CEO, with no prosecution pursued. Together, these developments mark the end of all legal proceedings involving the group's top executives. We view this as a positive development that removes a major corporate governance overhang and restores leadership stability. With its improving operational momentum, strengthening overseas contribution, and the removal of corporate headwinds, we believe Able Global is poised for sustained growth going forward. Therefore, we would like to reiterate our buy recommendation on Able Global with a TP of RM1.98, based on pegging unchanged target PERs of 10 times and 8 times to the CY26 earnings of its F&B and tea manufacturing segments respectively. So based on today's closing price of RM1.54, there's a potential upside of about 28.6%. Thank you, and this comes to the end of my presentation, and I'll pass it over to Jessie to continue.
Good evening, everyone. I'm Jessie, so I will introduce AWC, which is a one-stop solution provider of premier engineering services and asset management solution. So AWC is principally engaged in the business of providing building maintenance, critical asset refurbishment, automated waste collection, high-quality plumbing, real engineering, and management. So the group generates its revenue through 4 divisions, which are Facilities Division, Environment Division, Engineering Division, and Real Division. So AWC maintains the facilities, security, and cleaning services to the federal government, commercial, healthcare, and university under the Facilities Division. And this division made up half of its total revenue contribution. And for Environment Division, AWC involves in designing, supplying, installation, testing, and commissioning of the automated pneumatic waste collection system under the Stream Group. AWC also provides a series of plumbing services under the Engineering Division, including designing and building of cold and hot water plumbing systems, rainwater harvesting, distributing the components for air conditioning system for buildings, and providing building management system. And for rail division, AWC will supply track materials, rolling stocks, provide maintenance services of railway tracks, track and depot equipment, as well as supply and commission of track tools, equipment, and machinery. So some updates for the environment division. So AWC's stream group is responsible for managing wet waste, accelerating the overall garbage collection process, and providing system maintenance. So Saudi Arabia's construction sector has slowed down significantly, with the mega projects over there are reduced by about 77% year-over-year in the first 5 months of 2025 due to a budgetary constraint arising from weaker oil prices. While there may be intermittent improvements, we remain cautious in this division and expect only marginal revenue growth in FY26, premise to slower than expected project recognition in the Middle East. Although near-term momentum in Saudi Arabia might be subdued, but we still expect the margin under this division to sustain around 25% as we see continued growth opportunities from rising adoption of the stream system by property developers in Malaysia, particularly in Penang and Johor, as well as steady contribution from Singapore housing projects. So we recommend a buy call for AWC with a TP of 83 cents based on our FY26 sum of the parts valuation, which indicating a potential upside of 24.8% based on yesterday's closing price. And the buy recommendation is supported by its strong order book, its job loads from domestic and overseas projects to spur across all divisions, proactive exploration of the global business opportunities, and the company business which promoting ESG practice. And I move on to CAB. CAB is a farm-to-fork integrated poultry producer which principally engage in the upstream to downstream business activities of the poultry industry. CAB involves in farming the parent stock day-old chicks and hatching of eggs into day-old chicks, farming, processing, and marketing of the broiler chicken, as well as operating and franchising of fast food business. So the group generates its revenue through integrated poultry division, supermarket division, fast food division, and drone division. And if you zoom into the integrated poultry division, primary processed chicken is the main revenue contributor to the segment, followed by sales of feed. So during early of August this year, CAB plans to buy over a commercial animal feed manufacturer named Cargill Feed Sdn Bhd for about 231 million in cash. So this Cargill Feed Sdn Bhd is a company that makes animal feed for livestock and fish with factories. And these 4 factories have a total production capacity up to 400,000 tons per annum, and 4 of these factories are running at an overall utilization rate of 50%. And the deal is expected to be complete by end of November this year. So we view this acquisition on the positive side as CAB is also involved in the trading of animal feed, which contribute about 24 to 28% of the integrated poultry segment revenue over the first quarter of FY24 up till third quarter of FY25, which is the latest quarter. By leveraging Cargill Feed's established expertise in feed manufacturing and distribution, CAB also stands to benefit from internalizing feed production to enhance supply chain efficiency and cost control within its poultry operations, and expanding its third-party feed sales to strengthen its position in the trading feed business. So beside from the positive catalysts that I mentioned just now, we continue to like CAB for its expansion in its downstream business activities and transformation into a full-fledged integrated food player within the next 5 years, being a supplier to various fast food brands operation within Malaysia, and also anticipate opening another 3 supermarket outlets by end of this year. So with all of these catalysts, we reiterate our buy call on CAB with a target price of RM1.21, implying an upside potential of 44.9% based on yesterday closing price. That's all from me.
I'll move on to the technical picks for this fourth quarter of this year. Firstly, we'll move on to the derivative side, whereby the looking at the FKI chart on the daily chart is currently on the uptrend of formation after bottoming out since early September. Since then, we are seeing a step up formation, and the index has been gradually stepping higher, rising above the 1605 level. Following the recent breakthrough above that, the index could likely to sustain its upward momentum towards the resistance of 1675 towards the 1692, while the support is pegged at around the 1606 followed by 1544. On the CPO price chart, while CPO price chart is on the mild retracement after the recent rebound since early May. After peaking at around the 4,600 per metric ton, we are seeing the short-term channel, or sometimes some traders will call it a flag formation. Currently staging a pullback, and in order to trade onto FCPO, the price needs to break through above the 4,461 level. If that were the case, the price may likely to advance towards the 4,611, followed by 4,722. But in the event that it could not break through above the 4,461, the price may likely to retrace towards the lower band of the channel, or lower band of the flag, at around the 42.76, followed by the 41.76. On gold prices, gold prices delivered a remarkable performance in the last quarter after the following the ascending triangle formation, a breakthrough above the 3,434 per ounce. The uptrend intact formation has been re-established, with the price rising above the short-term moving averages of EMA 10 and also the EMA 20. Since then, it has been hovering above the EMA 10 level over the past about close to 1.5 to 2 months trading period. On gold prices right now is likely to head towards the 4,000 per ounce, and upon a successful breakthrough, the next resistance is located towards the 4,100. Support is located at around the 3,720, followed by the 3,620. On the FMKLCI daily chart wise, the FMKLCI daily chart is on the upbeat momentum. Right now, the uptrend formation is still very much intact, as the index managed to climb above the long-term SMA 200 level in recent months. With that, the index also managed to climb above the short-term moving averages of EMA 10 and also EMA 20 over the past about 2 months trading period. But we are seeing a bearish candle being formed lately. These charts are all based on last Friday closing. With the bearish candle being formed on last Friday, we expect a potential pullback to take place, and should the 1600 level were to be defended, the recovery trend may likely to power the index higher towards the 1675 or even towards the 1700 psychological level, while the support are located towards the 1611 followed by the 1562. So long as the index managed to stay above the 1600, we think that the upward momentum will likely to remain upbeat at this point of time. Over at the weekly chart, we are seeing the more prominent rebound move, whereby after a retracement, multi months of a retracement, it has formed a hammer candle since early of this year. After a long hammer candle forming the double bottom formation at around the 1400 level, we did see a trend line breakthrough early on above the 1562. With the breakthrough above the 1562, the index has been steadily climbing higher, breaking out above the 1600, 1611 resistance level as well. With the successful breakthrough above the 1611, the index may likely to advance towards the 1675, but after After a long stretch of rebound, we expect more consolidation to take place over time. So, like the daily chart, so long as the index managed to defend the 1600, then the upward momentum will likely to sustain towards the 1675 or even towards the 1700 level. Your support is located towards the 1611, followed by the 1562. On the small cap buys, small cap is on the relatively upbeat momentum after hovering just on a sideways trend in recent months. Since early of September, we did see the small cap manage to form a breakthrough above the 15,867 points after multiple sessions of gains towards the 17,000 psychological level. The RSI is currently on the overbought right now, so this suggests that cautiousness may likely to prevail at this point of time, and should the index forms a pullback, this could present an opportunity for investors to bargain hunt onto beaten down stocks. But until the index managed to surpass above the 17,000, the next resistance will be located towards the 17,500, towards the 18,100. Your support is located towards the 16,400, followed by the 15,800 points level on the small cap index. Overall trend is fairly strong at this point of time, given that it's currently hovering above the SMA 200 level. It has not hovered above the SMA 200 level since last year. On the sector-wise, we like the technology sector, which has been on a relatively upbeat trend, especially in recent weeks. On the technology index, although it's currently on the uptrend of formation, we expect further upside to be although it's already on the overbought position given under the RSI reading. We expect the uptrend momentum to sustain towards the resistance of 65 towards the 69. Support is at 54, followed by the 51. But after multiple sessions of gains as of late, we expect a potential pullback to take place, and index may likely to consolidate around the 58 to 59. So this range will likely to present opportunity for investors or traders to accumulate. Under the technology stock wise, we like Triren. I think today the price has already hit the first resistance of 43 cents. Uh, but looking at the chart right now is on the uptrend of formation with improvement in trading activities over the past about 2 months trading period. Is currently hovering above all its moving averages lines. In order to trade on this company, let's monitor for the potential flat formation breakout. It's already breakout I think today. Resistance is at 43 towards the 45. Support is at 37 cents. After today's strong bullish candle, if in the event that price were to stage a pullback towards near the breakout point of 41 cents, then that will present a lower risk zone for investors or traders to accumulate. Our next topic under the technology sector will be ATAC. ATAC is still on a consolidation pattern at this point of time in recent months. In order to trade onto ATAC, let's monitor for the potential breakthrough above the resistance of 114 cents. If price managed to break through above that, price may likely to advance towards the 140, towards the 130. Support is at 104 cents. But if you want to trade on ATAC on a more cautious tone, we can wait for the potential pullback towards near the 104 cents for us to accumulate. For the next sector, we like the Bursa Malaysia's construction sector is still very much on the upbeat trend right now. Despite consolidation taking place in recent months, we do think that this sideways formation deemed to be healthy for investors to digest the gains since early of April. So in order to trade on the construction sector, it needs to break through above the 338 points. Upon successful breakout above the aforementioned level, the next resistance is located towards the 350, followed by the 360. Your support is located towards the 323, followed by the 311. So if in the event that the index managed to break through above the 338, we expect the RSI, the MACD to form a buy signal, whereas the RSI may likely to strengthen its position above the 50 level as well. Under the construction sector, we like Kim Loon. Kim Loon is on the recovery phase right now, like most of the companies listed on Bursa Malaysia, whereby prices has bottomed out since early of April. Kim Loon has been forming the step-up formation, gradually rising above all its moving averages lately. In order to trade onto Kim Loon, uh, we need to monitor for the price to break through above the 150 cents resistance. This is the short-term consolidation, uh, the resistance of the short-term consolidation in recent weeks. Upon a successful breakout of 1 ringgit and 50 cents, next resistances are located towards the 160 towards the 175. Support is at 1 ringgit and 37 cents. Already we did see that following this step-up formation, this was also accompanied by improvement in our trading activities. Every time price rises, we did see a spike in volume as price tapered or stage a mild pullback. We did see a gradual decline in volumes. So this just suggests that most of the buyers are still in position on Kim Loon at this point of time. Our next pick is Nadi Gagasan Nadi Cerdas Berhad. Price is still very much on the upbeat momentum right now. Price has been steadily climbing higher, moving above all its moving averages lines. In order to trade onto this company, we need to monitor for the potential short-term resistance breakout above the 41 cents. If price can cross above the 41 cents, price may likely to advance towards the 45 towards the 50 cents. Support is located towards the 37 cents level if there's a breakthrough above the 41 cents on Nadi Berhad. Some other stocks that's not under the sector rated would be Kawan Energy. Kawan Energy has formed a mild pullback of mild retracement since July to August, but since last month or till early of this month, we did see a rebound taking shape accompanied by improvement in trading activities. Following the recent rebound, price has turned into a short-term consolidation pattern as of late. So this could be healthy consolidation or a zone that investors or traders can accumulate around these levels and monitor for the potential breakthrough above the 79 cents. If price can break through above that, the next resistance are located towards the 89 towards the 96 cents. Support is located towards the 31 cents level on Kawan Energy. So our last technical pick for today will be HE Group. HE Group has been steadily marching higher as well. On a good news is that price has really climbed up and also managed to steady it above the SMA 200 level, which is the green color line. And as of recently, we did see that price has been marching higher, closing above the short-term moving averages of EMA 20 and also the EMA 10 level. In order to trade onto a HE Group, we need to monitor for the breakthrough above the 45 cents. If price can cross above that, then price may likely to advance towards the 50, followed by the 55 cents. Support is located at around the 37 cents level if there's a breakout above the 45 cents level on a HE Group. So in short, these are our six technical stock picks for this quarter, and these are the strategy resistances and also the support levels. So given that the markets has been steadily marching higher, we need to monitor for the most of the companies. We need to see a monitor for the next resistance breakout in order to confirm for further upside. So that ends the presentation for this quarter. I'll pass back to Elkie.
Thank you very much, Kenneth and fellow analysts for their sharing and insights. Okay, yep. So if you have any questions that you like to ask our analysts, you can feel free to put it into the comment. Otherwise, we're gonna end our sections here today. Okay. Yep. Since there's no questions, then we will end our section here together. If you have any questions, you can feel free to drop at our Facebook Messenger with your contact number, and we will get back to you. Thank you very much for your time with us today, and have a good day. Bye bye.